Hello and welcome to Live Wire Markets. I'm Hans Lee and this is The Pitch. Joining me today, Fidelity International's Anthony Schramm. Anthony has been covering Asia for more than 20 years, and of course, while there are many economies in that continent, the one people really care about from Australia's perspective is China. And that is the subject of today's interview. So Anthony, I guess you would have heard people say a decade ago that Chinese stocks, just the Chinese economy in general, was this fantastic long-term play. But from where you stand and all the work that you do, maybe give us a sense of how China has changed in the last few years and some of the structural challenges that the world's second largest economy now faces.
There's a fair few structural challenges they face. I think if we were to sum it up into why Chinese GDP growth was so strong prior to that time period that you're mentioning, they very much had a machine in place that generated very strong credit growth in China. So, foreign direct investment was positive, money coming in. Trade surplus, money coming in. Capital account, so investors like myself, managing portfolios, money coming in. PBOC takes that money in US dollars, sterilizes it, so basically giving renminbi to the local companies, and then buying US treasuries with those dollars. So that local money supply of renminbi keeps growing and circulates in what is a relatively closed economy or closed capital account. So you had fantastic price growth in assets, for example, property, the stock market from time to time, solid GDP growth. That machine, by and large, ceased about 8 years ago. So if you look at the EPS for the Chinese market in renminbi terms, it's basically flat the last 8 years. So what's happened? Companies nowadays, it's flat to negative FDI, so money coming out of China. Trade surplus is still there. Capital account, I'd say it's deteriorating. So that machine that was generating a lot of credit growth and GDP growth as a result in China has kind of gone into reverse. And I think that's one of the largest structural challenges they have to deal with, besides things like demographics, the debt within the economy, lack of productivity growth, etc.
Okay, so given those structural challenges at a macro level, would you say that the best days for Chinese equity returns, on average, I know you're an individual stock picker, but just kind of speaking at that headline level, and again, just given what you said in that last question, are the best days for Chinese stock returns probably behind us?
Well, I think it's a really interesting question in the sense that stock market returns don't necessarily correlate with GDP growth or returns, no matter how much investors want to focus on that. They're two distinct things. So that's the first thing to bear in mind. And for the market in China, are the best days behind it? Well, I think what you'll see is, a lot of, let's call it cyclical swings and roundabouts. Be that the business cycle, could be sentiment. So there's good money to be made at the individual security selection level in such a market. Do I think it's going to power ahead like India? No, I don't. Are the best days behind it? We'll see. Open question.
Okay, so it's still an open question in your view. Okay, with that in mind then, some of the investors that we speak to are really excited about China. They kind of view it as this deep value opportunity, right? Where you've got some stocks trading 1, 2, 3 times PE, and some of them say it's too hard or it's uninvestable. Which camp are you in?
The former. Yeah. And the reason I say that is it's hard to characterize any market as uninvestable. It's always a question of risk versus reward. So from my perspective, what has changed in how you assess China and companies you're looking at in China, my hurdle rate of return for the fund to invest in a company has gone up. It's not to say it's uninvestable, you're not looking, the fund will never buy. No, it's just a question of risk versus reward.
Yeah, okay. No, I understand where you're coming from. So even if it's an open question as to whether the best days are behind Chinese stocks in aggregate, are you seeing some individual names that are able to stand out from that pack? Any stocks that you're seeing in China that are clearing that higher hurdle rate, as you say?
For sure. If you look at one interesting facet of the Chinese market that has emerged in the last quarter, again, just sitting at my desk scouring for ideas, you're seeing stocks and sectors starting to chalk up at valuation multiples that are cheaper than first quarter 2020. If you recall what happened in first quarter 2020, COVID hit, markets are crashing. most people thought the world's maybe going to end. Border controls are coming into place not soon after we had the lockdowns. But you've got companies like, for example, Galaxy, casino operator in Macau, Yum China, which operates the KFC franchise in China. Why are they priced below first quarter 2020 levels? Margins are healthy, growth is there. Okay, there's some slight different nuances, but from my perspective, it's a question of, is there something fundamentally wrong, i.e. has the industry structure changed, or has the company gone off the rails, or is it more too much negative sentiment? It's too hard, I don't want to deal with it, I want the baby without the pain, you know? So from where I sit, there's a lot of ideas starting to filter through like that. But again, from a portfolio level, risk management perspective, how much of that do you want?
Yeah, no, exactly. Well, how much of it do you want in the...
Not as much as it used to be, put it that way.
Yeah, no, absolutely. All right, Anthony Schramm, thank you very much for explaining that to us. And thank you for joining us for The Pitch. If you enjoyed that interview, you can subscribe to the Livewire Market Index websites, as well as our YouTube channel. Thank you for watching.